Hello, everybody, and welcome to another episode of the Capital Gains Tax Solutions Podcast. We're also streaming on Expert CRE Secrets Podcast as well, and YouTube channels where we believe most high net worth individuals and those who help them, they struggle with clarifying their capital gains tax deferral options. Not having a clear plan is the enemy. Using a proven tax deferral strategy such as the deferred sales trust is an amazing way for you to exit highly appreciated cryptocurrency, businesses, real estate. Eliminate the need for the 1031 exchange so you can get time back on your side to invest when it makes sense for you, all capital gains tax deferred. My name is Brett Swartz, and each and every episode, we're joined by some of the best real estate, financial, wealth, and crypto minds in the world, where they share their ideas, deal stories, and inspiration. So together we can make complex tax deferral strategies simple and passive income plans achievable. I'm excited about our next guest. He's originally from Germany. He's now in the great state of California, and he is focused on doing the right thing. And he built neural network for horse racing. He also had several other lucky turns led him to stay in the U.S. and eventually graduate from the Wharton School of University of Pennsylvania with a bachelor's in economics. Since then, he's been a consultant at Oliver Wyham, started an online insurance company, spent 4 years at FICO, and grew enormous from about 2 million to over 25 plus million before selling it. And right now, he is focused on being the CEO of Omify, which partners with first-time homebuyers with socially conscious investors. And together, he's creating a new path to ownership for real estate, trying to help solve some of the massive challenges with home ownership. Please welcome to the show with me, Frank Rode. Frank, how are we doing?
Good. How are you? Thanks for having me, Brett.
I'm doing fantastic. And for our listeners to get to know you for the first time, would you give us a little bit more about your story and your current focus?
Sure. So I spent the last 15 years of my career building a software company that was focused on pricing. It was basically the pricing engine for a lot of the large mortgage lenders. And so working with big banks in the US, Canada, elsewhere, got really deep into the bowels of mortgage math. And one of the things that we started seeing as part of that journey was that, the first-time buyer is getting squeezed out more and more. So, young people trying to buy houses in the US are facing really the toughest environment in probably 50 plus years. And I think everyone knows that anecdotally, and I'm happy to dig in and kind of walk through the reasons why, but basically decided, that I wanted to help solve that problem. So I sold that company, started a new company called Ownify, and our mission is to create a new path to ownership. So really an alternative to the traditional mortgage that people use to buy their first home. And specifically an alternative that allows people to overcome that down payment hurdle, right? Which is the largest barrier to entry for a lot of folks out there. So I started that company, Ownify, 2 years ago, been working on it. We're live in North Carolina, have done a number of transactions, started a fund, and are now working on expanding that model. And obviously, as you dig into that, you run into all the interesting tax challenges, which is, I know, one of the big focus areas of this pod. So, happy to dig into that. But basically, the core focus for me and what I'm working on is, bringing together very qualified first-time buyers and savvy investors to solve this home ownership financing challenge, right? Specifically focused on the first-time buyer.
Absolutely love it. And by the way, you can learn more about Frank Rode by going to ownify.com. That's own and then ify.com, ownify.com. And Rode is spelled ROHDE. And so we're talking about navigating the real estate maze. Before we go there, Frank, I want to take one other step back. I believe we've all been given certain gifts, and these gifts have been given us to be a blessing and help to others. Some people call them strengths, some call them superpowers. I'm curious, what would you feel like is that one, like Frank is like just always been really good at this thing? Like, what is that thing, and how does that help and bless people today?
I think it's the unwillingness to give up, or just to keep solving and keep working and keep digging in. There's a lot of barriers to what we're doing, right? There's a lot of barriers to what I've done in the past. And I think as an entrepreneur and a builder, a founder, you face a lot of obstacles, and you just can't give up. There's always going to be another solution, another door, another path, right? And so a lot of it is about the grit and the endurance and just the willingness to keep going, even when things might be tough and it might seem like there isn't a path forward. And so, I run marathons, or, fewer now, but I used to run a lot of marathons. And this is part of the endurance and keeping at it. I think that's probably my biggest strength. I'm not any smarter than anyone else, right? I don't have any natural talents and gifts, but I work hard and I grind.
Excellent. Absolutely love that. So with that in mind, let's dive right into the topic at hand, which is navigating the real estate maze. And so, Frank, what is the number one secret to what Ownify is doing to help homeowners and looks like savvy investors, right, that have a conscience for wanting to help people getting to houses? Walk us through that secret to what you guys are doing and how it's all working.
Yeah. So we started with this question, or just one step back. If you look at why our first-time buyer is struggling, there's a bunch of reasons coming together today that maybe didn't exist in this constellation in the last 20, 30 years. And the first one is house prices themselves, right? I think everyone knows this, especially as investors, right? House prices are higher than they've been in the past, and they continue rising. And that's fundamentally because we're short housing in the US, right? Depending on what you read, 2.7, 2.8 million units. So you have house prices that keep going up. You have most first-time buyers now have student debt, significant debt load, which depresses their budgets. You have a lot of corporate and individual cash buyers that you're competing against. So even if you do qualify for a mortgage and you can get into the financing, a lot of times when you as a first-time buyer show up with an FHA mortgage or a down payment assistance program or some other version of making it work, you're competing against cash buyers and you're getting outbid in the market. So there's a bunch of reasons, right, coming together. And the tax deduction of mortgage interest is largely unavailable to first-time buyers because in that income category and in that mortgage size bracket where you're buying a $300,000-$400,000 starter home, you usually don't itemize and get that tax deduction. So a bunch of reasons coming together why first-time buyers are struggling. And so when we looked at this, we said, well, why do we buy homes the way we do? And in the US, there's a very standard way of buying a house, which is you take out a 30-year mortgage. By and large, it's a government structured and sponsored product. And you go out and, you buy the home, you hold title, depending on the state, you sign the title, but basically you get a lot of debt to buy a house. And then you pay that debt off over, the next 30 years, and maybe you refi and, eventually you might sell the house. And so the question that we asked is, why do you have to buy your home all at once? Why couldn't you buy your home brick by brick, as we call it, right? Or in fractions? Why is it not possible today to go pick a house and then, live in that home and own a portion and rent the other portion, right? And if you think about that, it's actually a fairly simple question, but it's really hard to engineer that. And so, navigating the real estate maze, one of the things we dug into then is, what is the notion of ownership? What does ownership really mean? It turns out ownership is a bundle of rights, right? And one of the big rights and important rights is obviously the right to occupy the home. A big right is the ability to control what happens to the home, so to sell it or to hypothecate it or lend it, borrow against it. And so we looked at that bundle of rights and said, this is what ownership means. And we took it apart and then put it back together in a different fashion. And so what Ownify really does is we fractionalize homes into investable shares, or bricks as we call them. And what that allows us to do is create an on-ramp for the first-time buyer. So the way that works is, the first step is we qualify buyers. So we because this is a big problem, we get a lot of applications. And we've built an engine that looks at, credit and income and ability to afford a home. And then, once someone has gone through that, which you can do at ownify.com, you get a budget as a first-time buyer. And that budget is generally between $250,000 to maybe $750,000 at the high end. So this is really targeted towards starter homes in most of the country. And once you have a budget, you go out and shop for a home. If you find a home, we underwrite the home as well. And so we look at, the valuation, the physical, the inspection of the property, and we create effectively an investment budget for that specific property with that specific owning, as we call them. At that point, we buy the home as an all-cash buyer. We use a fund that we've put together to do that. And we fractionalize the home into 10,000 bricks. So what does that mean? It means we issue shares in an LLC that holds title to the home. And so each share, each membership interest in that LLC, which we call a brick, is effectively an ownership interest in the home, right? And if you think about a $400,000 home, that means a brick is worth $40 on day one. What we then do is 10,000 bricks are issued. The customer, the owner, buys 200 bricks, or 2%, which is really the down payment required for our solution on day one. and they enter into an agreement with Ownify that effectively allows them to live in the home for 5 years. So there's a 5-year lease. There's also a 5-year equity share agreement that effectively structures the purchase of equity from Ownify over 5 years. And so on average, the customer buys about 13 bricks per month. That's 13 basis points, right? Which gets you to roughly 1.6% per year, times 5 years gets you to 8%. And so with the 2% down payment, that math, right, that agreement gets you as a buyer to 10% equity at the end of 5 years. Now, the interesting thing is this is not a mortgage, so there's no obligation to ever pay off the full balance. There's also not a fixed interest. Really what's happening is we're valuing each home in the portfolio and therefore each brick every month. And the transaction where the customer buys bricks is done at that market value. So that $400,000 home on day one, in the first month, the brick is worth $40. In month 2, it might be worth $39 or $41 or $40.50. And so the value of the brick fluctuates with the value of real estate over time, which really means that what we're allowing the customer to do is dollar cost average the purchase of equity in the home, right? And because they're making a fixed payment, in some months they're buying slightly more bricks, in some months they're buying slightly fewer bricks. But the way the math is dialed in is such that at the end of 5 years, you end up with 10%. Now, you may ask...
Okay, pause. Gotta make sure I got it. That's a whole lot there, right? So yeah. I'm going to try to unpack some of this. Okay, so yeah, okay, I get it. So it's expensive, right? Mortgages are expensive. Down payments are hard to come by. And so what you're trying to do is kind of on-ramp somebody to put 2% down and then have like a 5-year, kind of like it sounds like a lease and an equity share that's built in, that every time they're making the monthly, let's say, payment in this scenario, or monthly investment, I guess is a better way to put it because it's not a mortgage, they are slowly building up some equity. And over 5 years, they'll get up to 10%. And essentially it's you're buying fractional buying every single month. Is that a fair summary so far?
That's good. Exactly.
Okay, keep going.
So at the end of 5 years, what happens? At the end of 5 years, the customer has 10% equity. And at that point, they have the option to buy the remaining equity, i.e. the 90% that's still outstanding, from the other entity. And I'll talk about what the other entity is in a second. And so they can do that with a mortgage, right? Because once you have 10%, that's enough for a down payment. You can go to any mortgage lender and say, here's my built up equity, which by the way has happened as private shares, right? And we have an accountant, you have this payment history over 60 months. So that's a very clean transaction with a mortgage lender. And at that point, it's a non-competitive transaction because you as the owner have the right to buy the home from the LLC. There's no other bidder, right? You can take all the time in the world. It's not a competitive situation. However, you're buying it at the then market value, so at future market value. And that market value will have been established because there's a walk of 60 individual transactions that got you there. And so part of the core of what we've built is this valuation engine that puts a price on every property every month. So the question obviously there is, well, what about the other 90%, right? Or on day one, the other 98%? And that's where the other side of the value proposition is really an investor offering, because obviously we got to buy the whole house, right? And what the customer agrees to is they're building equity over time and they're renting the bricks that they haven't bought at any given point. So over 5 years, they make a rental payment that goes down and they buy equity. And the more equity the customer has bought, the less they have to rent, right? Going from 2 to 10%, which means they have to rent on day one, 98%, and in 5 years, 90% of the equity. So for that balance, we've established a fund. It's called the Ownify Home Fund. And we have investors who put money into that fund. Effectively, those are accredited investors. And that fund earns rental income on the bricks that are being rented effectively by the customer. And the fund also earns appreciation, right? Could also be depreciation, but effectively the value of an investment in that fund is tied to the value of the underlying real estate. So what we've done on the investor side is we've allowed investors to access owner-occupied residential real estate in a long-term contract and participate in the appreciation and the cash generation, right, the income potential of that asset.
Okay, pause. Okay, so it sounds like it's a 98% joint venture partnership where you're asking an investor to partner with you on this house that, hey, I just bought my house right across the street here for $1 million. And I'm like, look, if you come with 2% down payment, right, you can live in the house, right? And if you're making, I don't know, we'll figure out how much they're making per month payment, right? Or investment per month, I guess is a better way to put it. We will own this together, and it's going to slowly, more of it's going to be rent in the beginning, but I guess depending on the fluctuation, it'll rise up. You're buying your equity as you're living in it. And then I had a 98% to start, but in 5 years I'll have 88%. Am I doing the math correctly, Frank? Or what am I missing?
That's right. That's exactly right. Yeah. And we asked this question early on and said, well, what would you do if you and your brother or your sister, right, or your best friend bought a house together, and you lived in it, and your partner, who you trust really well, was the silent partner? How would you structure this? We said you would probably ask for rent, right, on the half that you don't that you own but don't live in. So what we're doing here is structurally very similar, only we're doing it at scale, and we're doing it across potentially hundreds of investors and hundreds of ownees in individual assets. So the ownee lives in it, pays rent on the fraction that they don't own. The more they buy, the bigger their stack of bricks, the less they have to pay in rent. So what this does, it actually creates a couple of really interesting things. The first one is alignment of incentives, right? So this co-ownership mentality means that the ownee living in the home, and we've seen this in the first year where we had homes in the portfolio, the ownees treat homes much differently than a traditional tenant would, right? So they fix things, they really treat the properties like they own them, which they do fractionally. And so what that means for the investor is that you're effectively paying a lot less in maintenance, right? Which increases the yield and the return on that investment. So you have this co-ownership mentality, and the alignment around, someone living in the home and owning a fraction of it treats it very differently than someone who's just a tenant. That was one thing. The second thing that we saw was, because there's a lot of demand, we can be very selective. So the portfolio so far has an average FICO of 740, right? Average payment to income of somewhere around 32%. So these are very highly qualified buyers. And when you dig in and you look at, well, who are those folks? Who are the people that are jumping on this program? They are what I would call the missing middle, right? They're folks who are in creative jobs, they're nurses, they're teachers, public sector workers, right? Folks with college degrees, they have good jobs, they make a good amount of money, but they're not wealthy, and they haven't had enough time to save the down payment. So really what we're doing is we're allowing them to jump that hurdle into real estate ownership. Because of the way the program is structured, you also have this interesting dynamic where, if you look at it as an SFR investor, as a single family rental investor, right, you don't have lease up costs because we don't buy a home until we actually have the ownee contractually committed. So they pay rent from day one. We've had also 0% vacancy, and because of the quality of the portfolio, we've had zero late pays. And so all of that ultimately comes together to increasing the yield on the investor side to somewhere around 300 basis points above the average for SFR investments out there. And that's an attractive value prop to investors, which is why we started the fund to say, Ownify Home Fund sources capital at market and above market rate in an asset class that people understand and like. And at the same time, we're solving this societal problem, right? Ideally in local communities where lots of homes are being bought up by, private equity and investors, and they're not available for purchase, right, for owner-occupied individuals. And so what we've done is kind of created this hybrid, right, alternative path to ownership that solves both problems, right? On the one side, get access for investors to local single-family homes as an investment opportunity. On the other side, solve that on-ramp problem.
Got it. Okay, got it. So it sounds like the lease option JV hybrid, right, where it treats, where it helps the seller treat the buyer well, and the buyer to treat the seller well. Kind of it aligns their interest because they both have ownership, and it leads to typically less maintenance, typically lower vacancy, and less lease up cost, and that creates that delta of increased returns. So let's get really practical, right? So on the deals that have closed so far that you've done, A, how many have you done? B, how long have they been going for? And then C, what happens if the renter, or the 2% owner, let's put it that way, right? The 2% owner, what happens if the 2% owner stops paying? There needs to be an eviction, right? There's that part of it, but they say, well, I have ownership. Like, walk us through just that part of the maze if it does go sideways.
Yeah. So first answer, we're young, we're early. We launched in May. We've done 6 transactions, so we have 6 homes in the portfolio, and so far that's gone really well. As I mentioned, no late pays, no issues. but you always have the potential, right? And so as we built the program, spent a lot of time working through what happens in the exit case, right? What happens if the owner needs to leave, their job moves across the country, and they need to move. So there's a couple of ways in which the exit works. One, the golden path is the one that I described, right? Which is the customer builds equity, and as soon as they have enough equity, they exercise their purchase option, they buy the home, they own it the traditional way with a mortgage. That's path one. Path two is, let's say the owner needs to leave. At that point, we buy back their equity and we charge them a relisting fee. That relisting fee is 4% on day one. It goes down to 2% over time, so it kind of melts away a little bit. And the reason we structure it that way is to make sure that the owner still has a stake in the home, even if they have to leave, and they, effectively get paid out for that. But we also, need to cover the cost of then selling the home and putting it back on the market. In the case where the owner just stops making payment, effectively, legally, the structure here is this is a lease agreement with a purchase option and an equity share, right? So if you don't make payments under a lease agreement, there is an eviction process that happens per individual state law, right? And the local process. Part of why we're so focused on the underwriting standards and sourcing really high quality customers is to avoid that, right? My co-founder built a 5,000 home portfolio for one of the rent-to-own companies out there, has lived through that, and has lived in particular through what happens, right, when you put people into homes that they ultimately can't afford and they default, right? And that's not a process that anyone wants to go through. It's not good for the customer. It's not good for us, and certainly not for the investor, right? So we're trying early on upfront to avoid that. And really, the underwriting process is focused on two things. One, sourcing high quality customers, ONIs as we call them. And then two, sourcing high quality assets, right? And making sure that we put those two combinations together. And that should avoid that issue. Now, it will never avoid it 100%. So there will be that, that unfortunate incident at some point in the future. And one of the things we want to do as a company, right, obviously is making sure that we do right by the customer in that situation as well. And make that transition, even in a scenario where they can't pay, as painless as possible for all parties involved.
Yeah, I love it. I think it's really creative. I think it's out of the box, and I think it is aligning. And I think that sometimes that's the frustrating part for renters, right? Where they don't necessarily feel like it's aligned. They feel like the rent's getting pushed. They feel like they're getting, priced out of the market, and they're just trying to live in a community. And if there's any way to align the interest by taking the banks out of the middle, man, that's amazing, right? So let's talk about like practically numbers wise. So if I'm an investor into the Ownify fund, which it sounds like I'd be let's say, I don't know if it needs to be probably a credit investor, passively investing. I put $1 million in today. Let's just say it goes into across 6 houses, or let's say an average is 400,000. Let's just say just 2 houses, just 2 at 500 each, right? What's kind of the return expectations there and numbers? How do those look in, Frank?
Sure. So target IRR over the 5-year hold period in the fund is 15%. And that's really a combination of the cash rental yield, which so far has been about 5.8%. That's what we generated last year. We continue to generate that going forward. So that's effectively the rental income, minus property management, taxes, insurance, maintenance, and that gets paid out to the investor. And that's a quarterly dividend, right? So that can either go back into your fund and increase the balance, or you can take it out, in which case it gets taxed. But that's the cash on cash return. And then you have another, so far we've seen 6%, but again, it's early, home price appreciation, right? And this is back to picking the right assets in the right markets and having a good model around that. And then aggressive entry pricing, right, to make sure that we generate home price appreciation. So you have the cash on cash return, home price appreciation with a little bit of leverage, and we've been very conservative on that. We get to about 15% IRR. And you're right, it is for accredited investors only, at least today. That's the exemption we have with the SEC, and that's how we're building the fund. There are a couple of interesting things. So one, you can come in as a cash investor and put money into the fund. What we're working on is also allowing investors who have current rental properties to come into the fund. And there's an interesting structure that we're working on that would allow someone to effectively sell the home that they've held as a landlord to their tenant, either their existing tenant or potentially a new tenant, by contributing the home into the fund. And that's an interesting tax advantage transaction called the 721 exchange, where you contribute your real estate into the fund, And we then use that real estate and that structure we've built, that fractional ownership structure, to sell that home to the existing tenant, right? So for landlords out there and investors out there who have existing single family homes and maybe tenants who are living in them who are interested in buying them but can't make that down payment hurdle, we're working on a structure that overcomes that and allows the investor to take advantage of that 721 tax defer exchange effectively.
That's cool. Yeah, we absolutely love capital gains tax solutions here. Capital gains tax solutions. That's exactly right. And that 721 is a unique way to do that. That's really cool. I do want to shift a little bit while we're talking about capital gains tax and exchanges and such. And it has to do with the biggest frustration and your background with real estate. I'm curious what you think with when it comes to the 1031 exchange, but in particular, unlocking capital from other sources that are non-real estate related. For example, you're in San Francisco, right? And huge amount of just north of Silicon Valley, and you guys are a lot of people own a lot of cryptocurrency there. I had a couple clients. One worked for Google. She had 50,000 of Bitcoin, went to 50 million, and she was able to exit 5 of that million before the last crypto crash. As of today, crypto's hit an all-time high at $72,000, Frank. And so what we were able to do is we were able to exit her Bitcoin when it was at 54,000 a coin a couple of years ago, defer the capital gains tax, and then put it into a startup company, all tax deferred. So it's kind of like she 1031 or 721 into a startup, non-like kind, no timing restrictions. It was not a 1031 exchange, okay? All tax deferred, right? Now, we went and did this with a second client. He had Ethereum, mostly Ethereum, but also Bitcoin, 7.5 million of the exit. And we call this building a capital gains tax exit plan. And we do this to unlock freedom and impact, and so the idea is, how do we help people who want to be in real estate, but have a huge tax burden, want to invest and do good, like what we're talking about here, but don't know how to bridge the gap there without having to do some kind of forced 1031 or even 721 can be very restrictive because it's just real estate, right? Yep. So just talk about the impact that could have if someone has $100 million of Bitcoin right now, wants to come into a fund like yours and can do that in a tax deferred way that goes right into the fund.
I mean, if we could engineer that, right, and this is something we might have to work together on, that would be fantastic, right? I think where we see the opportunity here is sourcing capital across a number of different places, right? And crypto, especially locked up crypto today, quite frankly, isn't doing anything good for the world, right? It's appreciating. But one of the things that we are very focused on is really allowing people to have impact with their investment. And you could have that in your local community. So we've had investors come in with different capital sources to say, I want to help folks in this particular community, right? We have a retired UNC professor who really cares about Chapel Hill and wants to make sure that we enable homeownership in Chapel Hill. So we've done that. We have other folks who have very specific areas of focus and interest, right, or communities they want to support. And to the extent that you can use crypto that's locked up, and especially if you can engineer a tax deferred solution of moving that capital into real estate, I think you're doing two things. One is you're potentially having an impact in your local community, right? Or for folks who need help, that missing middle, right, to make the jump into homeownership. And two, if you can do it in a tax deferred way, right, you're putting that capital into a much lower risk asset class, right, that maybe isn't as exciting as crypto, but certainly not as volatile either.
Absolutely. We couldn't agree with you more. And people want to learn more about this. You can go to capitalgainstaxsolutions.com. We also wrote a best-selling book on it as well called Building a Capital Gains Tax Exit Plan. And it's, we believe the proven strategy to unlock highly appreciated assets, defer the tax, and invest into exactly what Frank is talking about, real estate or businesses, or invest back into cryptocurrency when it makes sense. The key is getting timing on your side and not feeling trapped by not selling or having to move to Puerto Rico in order to get a tax advantage. You can just build a capital gains tax exit plan with us here at Capital Gains Tax Solutions. We've already proven it. It's already worked. And we believe we're in the bull market run for a lot of people here in 2024. So just go to capitalgainstaxsolutions.com. That being said, Frank, are you ready for the lightning round?
Go for it.
All right. Knowing what you know now, if you could go back to your 25-year-old self, what's the one golden nugget and make sure to tell yourself to do?
I would tell myself to evaluate the advice that you're getting from folks around the table much more critically. Right? I think it's easy as a 25-year-old. You meet people who are successful, who are rich, who are have made a good career, and you listen to them and you believe everything they say. And there's a whole bunch of kind of survival and selection bias in there. So just be a little bit more critical about who you believe, what you hear.
Excellent. Question number 2: what's the number one book you've recommended or gifted the most in the past year?
I don't actually have a good answer on that. I've read a number of nonfiction books, and the one I would really recommend is Magic Mountain, just because it is so different than the work you do on a day-to-day basis and the work I do on a day-to-day basis. It is the best way for me to wind down at the end of the night. It's a fantastic book. I co-read it with a good friend of mine. We exchanged notes about it. So maybe not the recommendation that you normally get on this pod, but Magic Mountain, Thomas Mann.
That sounds cool to me. Question number 3, what are you most curious about right now?
I'm learning a lot about tax and capital gains tax, the 721, the 1031 exchange, really how to optimize my fund and the business we're working on, for that. I'm also learning a lot about impact investing and DAF and, how donor advised funds can play a role in this. So generally digging deeper into, IRS and taxation.
Absolutely. Well, we're here.
So it's kind of why I'm on this pod too, right?
Yeah. Well, we're happy to help. We're in the battle here too for that. It's $84 trillion transferred in the next 20 years, largest wealth transfer history of the planet. And a lot of that's tied to high-end primary homes, business, cryptocurrency, and commercial real estate. And so the extent that you can unlock that, it can make a huge impact. But as long as it just stays dormant, it just can't, right? It's just sitting dormant, right? And so to be able to unlock it, we did an $8 million deal on Palo Alto, a primary home seller who was trapped until they found us. We've done Menlo Park, we've done San Francisco, we've done LA, we've done San Diego, and deals across the country. And so it's really neat when you can find a strategy that can do the things that unlock the impact. And so we get it. So next question is this, favorite leadership quote or theme that you strive to live by?
It's really the attention to detail, right? Of do all the little things well and all the big things will come together. And I forgot actually who said that.
But that's a great one. I love it. Last question. After all your success, Frank, helping all the people you've helped, building the companies you've built, and accomplishing what you've accomplished, how do you best stay centered in your values and stay encouraged to charge forward to reach even higher heights?
It's really the reflection, right? At the beginning of the day, the end of the day. And this is also why I mentioned this book, kind of just winding down, creating that space where you can say, let me think about what I did today. Let me think about what I'm going to do tomorrow. How does it fit into my broader journey here, right? And ultimately asking that question, not just how do I do well for myself, but how do I do well for others, right? In the broader community. And I think this is where everyone who, especially folks who've been successful, have that opportunity maybe in the second part of their career to really think about, how do you give back? How do you use the skills that you've learned maybe in the first half or first part of your journey to then build solutions for society that have a broader impact, right? And so a big part of getting centered around that is really asking the question, what do you do on a day-to-day basis that hits both of those, right? Do well for yourself, but do well for others.
Frank, couldn't agree with you more. Thank you so much for sharing your wisdom, for sharing your vision, for helping to solve a huge crisis in America, which is home ownership, making it a win-win for the buyer, for the seller, for the investor, and being creative and thinking outside the box. I want to encourage you to keep using your relentless drive to dig in and solve problems and keeping at it. And thank you for being on the show. And for our listeners who want to get in touch with you, would you mind one last time, what's the best place for them to find you?
Ownify.com. And personally, I'm at frank@ownify.com. That's the best way to reach me.
Awesome. Thanks, Frank. And also want to thank our listeners for listening to an episode of the Capital Gains Tax Solutions podcast. As always, we believe most high net worth individuals and those who help them to struggle with clarifying their capital gains tax referral options, not having a clear plan is the enemy. Using a proven tax referral strategy such as the 721 exchange, 1031 exchange, and the deferred sales trusts that are amazing ways for you to exit highly appreciated assets, defer capital gains tax, and go make an impact, right? To unlock freedom. We absolutely would love the opportunity to work with you if you're having an asset sale of at least $1 million net proceeds, $1 million gain, a large gain there to build a capital gains tax exit plan. Just go to capitalgainstaxsolutions.com to get started today and check out the best-selling book as well, Building a Capital Gains Tax Exit Plan on Amazon. You can pick that up as well. Appreciate everyone listening out there. Please rate, review, subscribe. Please share this with someone it can inspire today.